Welcome to ValueVest Daily. You know, in the investing world, you're always facing this classic choice, right? Do you jump on the brand new shiny thing everyone's buzzing about? Or do you go digging through the bargain bin for a potential hidden gem? Today, we're putting that exact dilemma under the microscope. We've got a hyped-up IPO going head-to-head with a stock that's been beaten down to an all-time low.
So, that's the big question for today. Where's the smarter play for your portfolio? Do you ride the wave of hype and momentum with a fresh IPO? Or do you bet on the potential value of a stock the market has, well, seemingly given up on? It's a real showdown between future promise and current price.
All right, let's get into it. Here's our game plan. We'll start by setting the stage with our two contenders. Then, we're going to unpack all the hype around BitGo's IPO and stack that up against Bullish's crazy fall from grace. We'll put them head-to-head, look at the powerful psychology driving all of this, and then wrap up with a checklist to help you sort through it all.
To really get this, let's think about it like you're buying a car. So on one side, you have that brand new Tesla. It's fresh off the line, got all the bells and whistles, and man, everyone is talking about it. Then on the other side, you've got a car that's been through a demolition derby. It is banged up for sure, but the engine might still be a beast. Which one is actually the better deal?
And that's the fundamental choice we're looking at. Are you chasing that momentum, that excitement of what could be the next big thing, even if you know you're paying a premium for it? Or are you more of a value hunter, willing to look past the dents and scratches to find a comeback story that everyone else is just too scared to touch? So first up, let's talk about our shiny new Tesla, BitGo. As it gears up to go public, it's being sold as the Fort Knox of the digital world. And for good reason.
So what is BitGo, really? At its heart, it's all about security. It was founded way back in 2013, and its whole business is providing institutional-grade, super secure storage for digital assets. We're talking about hedge funds, big exchanges, maybe even governments, all entrusting their crypto to BitGo.
And the scale here is just, wow. They're already protecting $64 billion in assets, and this is before they even hit the stock market. Now they're looking to raise about $201 million by offering almost 12 million shares on the New York Stock Exchange. These are not small numbers.
And all of that brings us to the price tag. They're aiming for a valuation of nearly $2 billion. A number like that is just screaming high expectations, you know? It's fueled by this idea that crypto's going mainstream, and it's got a whole lot of hype baked right in. Okay, now let's walk over to the other side of the garage and look at our demolition derby car, Bullish. Its story isn't about fresh paint and optimism, it's about a massive, dramatic crash, which makes it a really interesting contrarian idea.
Now, Bullish is a completely different kind of animal. It's a high-octane crypto exchange built for the big players, the institutional traders. It offers the whole shebang: spot trading, lending, complex DeFi or decentralized finance integrations. You got to think of it as a platform built for speed and aggressive trading.
And this chart just says it all, doesn't it? I mean, look at that steep decline. After hitting a high of $118 back in August 2025, the stock just fell off a cliff. Now it's just hovering near its all-time low. This is a classic falling knife scenario, where you're trying to grab a stock while it's in total freefall.
So the key takeaway here is this absolutely staggering 71% drop. A collapse like that creates so much fear, so much uncertainty. And the big question for a value investor is that fear justified? Or has it created a massive sale on what might be a pretty solid business underneath? Okay, tail of the tape time. Let's put these two in the ring, side by side, the shiny new model versus the battle-scarred veteran. Looking at the hard data helps us cut through all the emotion and really see what makes these two companies tick.
This table really lays it all out. You've got BitGo as a defensive, custody-focused business, while Bullish is all about aggressive trading. Now look at this. Bullish actually brought in double the revenue in 2025, but it also lost more money. But the real story is at the bottom. BitGo is getting valued at 13 times its revenue, totally lifted up by hype. Meanwhile, Bullish, despite making more money, is weighed down by pure fear.
And that brings us to what I think is the most important part of this whole explainer. Because this isn't just about two stocks, right? It's about a battle between two of the most powerful emotions in all of investing: fear and the fear of missing out, aka FOMO. FOMO is what drives that frenzy around an IPO like BitGo. We've all felt it. You see the headlines, you hear the buzz, and that little voice in your head starts screaming, everyone's getting rich on this. I can't be the one left out. And that herd mentality, It so often leads people to buy in right at the peak of the hype and the peak of the valuation.
Now, on the flip side, you've got loss aversion. This is the engine that's driving all the fear around Bullish. Studies in behavioral finance have shown that the pain of losing money feels literally twice as bad as the pleasure of making the same amount. And this bias makes us want to run for the hills from falling stocks, often selling at the absolute worst time, just to make the pain stop.
So what you end up with are two totally opposing mindsets. You've got the herd mentality, which tells you to just follow the crowd right into the hot new thing. And then you have contrarian thinking, the classic value investing move, which tells you to do the exact opposite, to look for opportunity where everyone else is freaking out.
And this quote just captures that contrarian spirit perfectly. Some of the greatest investors in history built their entire fortunes on this one idea, having the courage to buy things when the sentiment is at rock bottom. It's all about separating a company's temporary stock price from its long-term underlying value.
Okay, so with all of that on the table, how should you, the investor, even begin to approach a situation like this? Let's try to boil it all down into a final checklist of the key risks and the potential rewards for each of these stocks.
Let's make a quick scorecard. For BitGo, the pro is obvious. You're getting in on the ground floor of what could be a critical piece of crypto infrastructure. The con? Well, you're paying a premium for that hype, and you've got this big risk of a sell-off after the lockup period ends and insiders can finally sell their shares. For Bullish, the pro is that massive rebound potential from a huge discount. The con? You could be trying to catch that falling knife we talked about. A stock is usually cheap for a reason, and it could always get cheaper.
All right, and I have to say this, and it's really, really important. This whole breakdown is for educational purposes only. It is absolutely not financial or tax advice. The goal here is just to give you a mental framework for how to analyze these things, but you always have to do your own deep dive research before making any moves. And that leaves us with one final big question for you to think about. When you look at your own portfolio, at the decisions you've made, which emotion has the stronger pull on you? Are you more likely to be driven by that fear of missing out or the fear of losing what you have? Honestly, just understanding your own biases is maybe the biggest first step to becoming a smarter investor.
If you found this explainer helpful, please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities you're looking at. Thanks for watching.